Have you ever wondered how big real estate deals are financed and who gets paid first? The answer lies in understanding the capital stack. Now, if you're interested in becoming a savvy real estate investor, whether actively or passively, then this video is a must watch. Today, I'll show you what a capital stack is in real estate and why it's so important to understand as an investor. The capital stack refers to different levels of capital, a mix of debt and equity that are used to purchase and operate a commercial real estate investment. The capital stack is designed to show who gets paid first because each layer of the capital stack carries a different level of risk and reward. The capital usually comprises of senior debt, mezzanine debt, preferred equity, and common equity. First, senior debt. Senior debt is the primary loan that you get on purchasing a property. An example of that would be that you're buying a property for $10 million. Again, we'll use easy round numbers. The senior debt is provided by a bank, Fannie Mae, Freddie Mac, and it typically is a first loan position against the property. Traditionally has about a 75% valuation, historically maybe as high as 80. In today's moment, it could be as low as 55, 60, 65% based on the higher interest rate environment we're in and what we're experiencing. So usually it carries the lowest risk because it is in first position and also carries the lowest reward. Next, we've got mezzanine debt. Now, mezzanine debt is a shorter term debt structure that's intended to provide additional capital proceeds. It goes in behind the first loan position, but ahead of other equity positions. So it has a higher risk and a higher reward, and it carries a greater return than that first loan position. Next, we've got preferred equity. Preferred equity means that it is ahead of any other type of equity, often carries a dividend or coupon rate associated to it, meaning that it's carrying a rate of return that's built in, whether it's paid current or not, it's still accruing a certain hurdle of interest rate that's associated to it. It has higher risk than you would with your first loan or mezzanine debt position, but also traditionally has a higher reward. And this is invested by the general partner and or limited partners that are coming in on it. There are also firms, meaning real estate investment firms, that specialize in investing preferred equity. So they may come in solely for the option or opportunity to invest preferred equity in a deal as well. The next position in the equity stack is common equity. Common equity is, again, it's equity that's coming into the project. It comes in behind any preferred equity that may be in the project. And let me just say too, you don't have to have both types of equity. It could be one or the other or both. So common equity typically has the highest risk and the highest reward. What I mean by that highest risk is when the project is being sold or exiting the project, the sequence or order of events, you pay off your senior debt, any mezzanine debt, any preferred equity, and then common equity as it relates to return. So again, this is done and invested either by limited partners, also the general partner, and again, there are also real estate investment firms that specialize in providing equity, both preferred and common, to real estate investment projects. So let's talk about an example of what that capital stack looks like and then who gets paid. So again, going back to that same example of a $10 million purchase, let's say in today's environment, you got a $6 million loan from the bank. There's, let's say, another $1 million in mezzanine debt that's being used with respect to doing capital improvements. Let's say that that's a part of this equation. The bank that you got, like for example, Freddie Mac does not provide renovation money. So maybe it is you've got this mezzanine debt. And then you have common equity. So in that structure, you've got $6 million that's your first lender, $1 million that is the renovation to the mezzanine debt, and then $3 million that brings you up to that $10 million that's common equity. So now when you have the property, you bought the property, it's already occupied, let's say 92, 93, 95%. You're beginning to make the value add improvements as we've done with many properties. You have that cash flow coming in from all the rents. The first elements of that money that comes in from your operations, the first line of payment goes to pay your mortgage, right? That's that first senior debt position. And then you also have to pay the operational expenses for the property. And then depending on the way that the mezzanine debt was structured, it could be pay current or it could be accrued till a future event. If it's paid current, then you also have to pay that in relationship to your current expenses. And then after that, any excess funds that are available now become available to distribute and pay to the common equity or preferred equity if it was a preferred equity investment in that capital stack. So now we've gone through it, we're beginning to operate and improve the project. Once we've done that, let's just say that we've gone through this period of time over the course of 24 months or 36 months, which, and again, like call it an 80 to 100 unit apartment complex. That's a reasonable time period that we've been able to experience and achieve those results. Now the property has been, you've brought rents from 800 to 1150. You've taken the majority of the units, let's call it an 80 unit apartment complex, and we've renovated 50 of the units. We want to leave some meat on the bone, so to speak. So there's an additional 30 units that still can be renovated, but yet by this time we've been able to elevate the rents to our pro forma targets. Now the property is ready for sale. We indeed sell the property. Let's say that we bought it for $10 million. We put the $1 million into it in the overall renovations and improvements. Now we're selling the property for $14 million. Once we sell the property, the order of sequence that gets paid back is the first line of monies that get paid back goes to the first lender senior debt position. They get paid back their $6 million. Let's say the mezzanine debt was part of this stack and they'd agreed to defer payments for the first 18 months. So they get paid back their accrued 18 months because let's say it's a 3-year hold. And then they also get paid back their $1 million that they've got plus any additional accrued return, as I've said. And then the last of those funds come back in and pays to the common equity or preferred equity along with the overall returns that are taking place on the project. So it's important to understand what position you are in within that. Now, most examples of properties that we purchase, we're purchasing them with some type of senior debt that we are able to obtain from either a bank relationship that we have, Fannie Mae or Freddie Mac, and then we're also bringing in either preferred equity with our investors, such as yourself, or common equity, depending on the type of structure and the type of deal it is, whether it is one of our what we call total return projects or preferred income projects. Kind of distinguishes for us how we go about doing it. So let's talk about what that means and how that translates into a level of risk. So in the example that I just shared, we put in $3 million of equity. We bought it for $10 million. There was $1 million of improvements, so that's $11 million. We sold it for $14 million, so that's a $3 million gain. So again, on our equity, that's a great return. We put in $3 million. We, after expenses and all that, are going to be just shy of netting an additional $3 million. Great return, clearly. But let's talk about, in today's environment, 2023, there are projects with other operators and people where that is not the case, right? So maybe it was not a good acquisition. Maybe it is that they underwrote it so that everything had to go perfectly. And of course, as you know, and I've shared before, nothing goes perfectly. You've got to have give in the underwriting. You've got to have conservative principles to protect from that. And then, of course, as we've seen, interest rates have really gone up where people underwrote, buying it at a 4 cap, selling it at a 4.5 cap. And now the market's gone to a 6 cap in many of those locations. So let's say in an example as well that an operator was forced to sell at a loss. They bought the property for the $10 million in the example we've shared. They didn't potentially execute well. And as a result of their loan maturing and lack of execution or interest rates going up, as we've seen, they ended up having to sell the property for less than the $10 million, right? So what does that mean and how does that translate? So let's say they sell it for $9 million. And then, you've got a capital repayment of the $6 million that goes to the senior loan position. There's the $1 million to the mezzanine debt position plus any accruals. So let's say that that's $1.5 million. So now you've paid out $7.5 million. There's only $1.5 million left of that $9 million to pay back the equity investors that invested $3 million. So you can see in that example, it's about a 50% loss. Now, again, these are just simple numbers to understand what the risk can be. And again, unfortunately, the truth is there are operators out there in 2023 that are going to be selling in 2024, and there is going to be a haircut on their equity. They are going to be selling, and it will be a loss because what? They underwrote the project and they anticipated it being a 5 cap, and now it's a 6 cap. That's compressed or hurt their values. They didn't have the right team in place to be able to execute, and instead of improving and getting rents to drive up, they weren't able to achieve that. So those are real things that happen, and it makes it critical and imperative to understand not only how the capital stack works, but also who you're investing with. I have a free gift for you in the description of this video, and I'm here to keep you informed so that you can make the best decision when it comes to investing your hard-earned money. And I've created a free guide to help you on your real estate journey. Click the link below to check it out. Well, that's all I have for you folks. If you've learned something today, make sure that you like this video and subscribe to my YouTube channel for more content on real estate investing. See you in the next video.